On to page 2 of the 1040 form. There may be some terms you're not familiar with on this page. Hang in there as we learn the IRS lingo. Line 1 is where you list your wages, sales, tips, etc. from your form or forms W-2 that you had if you had income from more than one job. Your employer is required to provide the W-2 to you by January 31. Even if you didn't get a Form W-2, you must report your earnings on line 1. If your Form W-2 is incorrect, ask your employer for a corrected one. Line 2 has 2 parts for recording any interest you received. 2B is for taxable interest, and 2A is for tax-exempt interest. Interest is reported to you on a Form 1099 INT. An example of tax-exempt interest is interest you receive from a state or local bond. An example of taxable interest is interest you received on your savings account at a bank or a credit union. Susan, taxpayer, didn't earn any interest, so on we go. Line 3 also has 2 parts. Part 3A for qualified dividends and Part 3B for ordinary dividends. If you were paid any dividends during the year, then you should have received a Form 1099 div. That Form 1099 div will show whether your dividends are qualified or ordinary. So what's the big idea about qualified dividends? Qualified dividends are eligible for a lower tax rate than ordinary dividends. Again, Susan, taxpayer, didn't earn any dividends, so on we go. Line 4 also has 2 parts. Part 4A is for any money you received from IRAs, pensions, and annuities. Part 4B is for the amount that is taxable. This is mostly relevant for retirees or people who withdrew money from these types of accounts. For our 25-year-old Susan, taxpayer, there's nothing to enter here. Just keep this line in mind as you think about retirement. Withdrawals after age 59 and a half from a Roth IRA are not taxable. However, if you receive money from a traditional IRA after that age, then some of that amount may be taxable. Line 5 also has 2 parts. In 5A, you list any Social Security benefits that you and or your spouse received. In Part 5B, you list the amount of those benefits that is taxable. Again, we're working with a young worker not receiving any Social Security benefits. Those doing retirement planning will want to look further into the current tax treatment of Social Security benefits. Please join the Aspire to Money mailing list for more great money advice. In line 6, you add up the amounts from lines 1 through 5 and any amounts on Schedule 1. Oh, brother, another form? Let's take a look at Schedule 1 to see if you have any of the additional income or adjustments to income that are listed there. Many people will not have any of these and so won't have to look at Schedule 1. For additional income, you'll see lines on Schedule 1 for state tax refunds, alimony, business income or loss, capital gain or loss, rental real estate, royalties, partnerships, S corporations, trusts, farm income, unemployment comp, and other income. Add all of those up on line 22 of Schedule 1 and then record the number back on Form 1040 line 6. Susan, taxpayer, didn't have any additional income. Schedule 1 also has adjustments to income. Adjustments include educator expenses for teachers, business expenses of occupations such as reservists, health savings account deduction, moving expenses for armed forces members, deductible for part of the self-employment tax, self-employed retirement plans, self-employed health insurance deduction, penalties on early savings withdrawals, alimony paid, the IRA deduction for a traditional IRA, and student loan interest deduction. I know that's a long laundry list, but these adjustments are added up and then recorded on line 7 of the Form 1040. Susan, taxpayer, didn't have any of these adjustments. Now on to line 8 of the Form 1040. Here you will choose whether to take the standard deduction or itemize your deductions. What the heck does that mean? Well, the standard deduction amounts are printed right on the form, for example. $12,000 if you are either single or married filing separately. Unless your itemized deductions are bigger than your standard deduction, you should take the standard deduction.